Well, TD is expecting the Canadian economy to be lukewarm this year, heating up a bit near the end of the year. Our next guest says trade uncertainty and slower population growth have been dampening business investment, but also sees some reasons for optimism. Here to tell us more is Maria Solovieva, and an economist at TD Economics. Maria, thank you very much for joining us.
Thank you for having me. Thank you.
Okay, so a little bit of a mixed bag. You see a slow start and then heating up near the end. What makes you think it's going to be slow for most of the year?
Yeah, so we think that going into the 2026, consumer spending slowed relative to December. We see that some of the items relatively healthy, and some of the items presumably a little bit slower. For goods, for example, we've seen a slowdown, significant slowdown in January. And then December data shows that there was a relatively healthy end to the year. And that's what we have been observing for most of 2025. There was spouts of acceleration and then followed by deceleration. So a little bit of volatility in the data. But overall, the year end was relatively healthy.
Sounds like everybody have kind of been taking, because of the tariffs and the trade talks, have been taking a wait and see approach. 2026 is looking somewhat similar. How much of a factor is the trade talks?
We do think it is a factor because it's reflected in consumer expectations. If you look at the Bank of Canada consumer expectation surveys, households are a little bit cautious. So their expectations for employment are a little bit cautious as well. And that is reflected in things like the savings rate. It's still running relatively higher to the pre-pandemic trends. And overall, I would say that this reflects the consumer cautiousness. But at the same time, we've seen in some of the spending data that consumers do continue to spend. This probably reflects the higher income end of the consumers because they are probably more impacted by the impact from rising equity prices. So a little bit of a wealth effect there as well. So we find that Canadian consumers are in a kind of balanced position because they are not splurging on spending, but at the same time taking a bit of a cautious approach. But some of the items that they perceive more important, things like spending on travel, for example, we do see a bit of a pickup in the internal TD spend data. So that's pretty healthy. And that potentially could be the reason for the pickup in there was due to colder weather. So that could be a factor for Canadians to dodge that bullet and get out of Canada into warmer destinations. But at the same time, things that you would consider more discretionary items, that they do know that you have to, with inflation prices being where they are right now, that you need to allocate some of your finances towards that.
And going the other way, the other one you mentioned, slower population growth, if we see any. I mean, we've seen some negative numbers the last little while. What kind of effect
affects the national numbers as well, of course. Yeah.
Sorry, one more time.
That definitely affects the national spending as well, to some, because you have just slowdown in population growth, so that reflects in the consumer spending too.
And are we seeing that on a regionalized basis as well? With are more areas affected by this, like an area like the Greater Toronto area, for example? Is that more affected by the slowing population growth?
Yeah, so if we look at our spend data, we are seeing Ontario, BC being laggard provinces in the recent months. And I think throughout most of 2025, they were laggard to the national growth rates. So things that have been weighing on consumers in these provinces, so slowdown in population, Also, some of the impacts of the housing market being less affordable, impact from the mortgage interest costs, and that is reflected in the condo market, especially in Toronto. That's also impacting the consumer to a great extent to in these provinces.
All right, and just one last question. The inflation data came out this morning. Any trends on that, and what kind of an impact it might have on the economy? And of course, bank rate cuts. Will the numbers we saw today, does it take us in any direction when it comes to the bank rate?
It was definitely a good surprise, and especially knowing that the GST impact will push prices a little bit higher year on year. So it was good to see still healthy deceleration in CPI. The overall, in terms of the impact on the Bank of Canada, it's still too early to say that this would make the Bank of Canada move the needle in terms of potentially rate cuts, because you do still see in terms of the breadth of inflation, you do still see the components rising above 3%, 4%, 5%. That is still a sizable impact. As far as I think it was like about 46% of components were rising at more than 3%. So that still will weigh on Bank of Canada in the coming decisions, in terms of staying on hold instead of making any decisions in terms of cutting rates. So we are expecting a gradual slowdown in prices, and mostly demand driven. Okay. With consumers being, like I said, fairly cautious, very selective in terms of what they're spending, and that eventually will drive the prices down. And we also expect some of the things that potentially will trickle down to move prices a little bit to more stable position. Okay. Things like mortgage interest costs potentially will be also giving a little bit of that downward pressure to the CPI, maybe to a lower extent than some other items. But so there is still, we're still cautiously optimistic about this. But at this point, the Bank of Canada, in our opinion, won't see the reason to move in any direction.
Okay, we'll leave it there, Maria. Thank you very much for joining us.
Thank you very much for having me.
Maria Solovieva, an economist at TD Economics.